Trading, in simple terms, is buying and selling assets in different markets. These assets can be shares, bonds, or currencies, basically anything with a fluctuating price. The goal? To buy low and sell high, profiting from the price differences. Think of it like buying Boer Wars at a discount and selling it at a higher price later on. Now there are many ways to approach trading. Some prefer quick trades, buying and selling within the same day, known as day trading. Others hold on to their assets for longer, hoping for long-term growth. This is often called investing. Regardless of your approach, understanding the basics is crucial. You need to know how to place orders, manage your risk, and choose the right assets to trade. Just like you wouldn't build a house without a plan, successful trading requires a solid foundation. Before you jump into the exciting world of trading, remember that it carries inherent risks. It's not a get-rich-quick scheme, and losses are part of the game. But with careful planning, discipline, and continuous learning, you can navigate the markets and potentially reap the rewards. Just like the South African weather, financial markets are unpredictable and ever-changing. One day the market might be sunny and bullish, with prices rising like a hot air balloon. The next, it could be stormy and bearish, sending prices tumbling down. This is where adaptability comes into play. Successful traders don't stick to one strategy no matter what. They adapt, like a chameleon changing its color, to suit the current market environment. Think of it like driving a car. You wouldn't use the same speed and approach for a clear highway and a busy city street. Similarly, different market conditions require different trading strategies. Understanding these market phases is key to success. During bullish markets, traders often ride the upward trend, buying low and selling higher. Bearish markets call for caution, with traders using strategies to profit from falling prices. By recognizing the prevailing market conditions, traders can tailor their approach and increase their chances of success. Imagine you're buying a used bakkie. You wouldn't just look at the shiny paint job, would you? You'd check under the hood, look at the mileage, and assess its overall condition. That's what fundamental analysis is all about in trading. It's about looking beyond the price chart and understanding the intrinsic value of an asset. For companies, this means digging into their financial statements, evaluating their management team, and understanding their industry landscape. Just like a healthy bakkie is likely to run smoothly, a company with strong fundamentals is more likely to perform well in the long run. They're the ones with strong earnings, solid management, and a competitive edge. But fundamental analysis isn't just about numbers. It's about understanding the bigger picture, the economic landscape, and how it impacts different industries and companies. Are interest rates rising? How's consumer confidence doing? These factors all play a role in shaping the market. By mastering fundamental analysis, traders can make more informed decisions. It's about separating the overpriced hype from the genuinely valuable opportunities. While fundamental analysis focuses on the why behind price movements, technical analysis is all about the what. It's about studying the charts, those squiggly lines that track price movements over time, to identify patterns and trends. Think of it like reading animal tracks in the bush. An experienced tracker can tell a lot just by looking at the tracks, the animal's size, direction, even its mood. Similarly, technical analysts use charts to identify patterns that can indicate future price movements. There are tons of tools and indicators in the technical analyst's toolbox. Moving averages, for example, smooth out price data to highlight trends. Support and resistance levels act like invisible barriers, showing where prices have struggled to break through in the past. Now, technical analysis doesn't predict the future, but it helps traders identify potential trading opportunities based on historical price action. It's like looking at a weather map. You can't control the weather, but you can use the forecast to plan your day. By combining technical analysis with other tools, traders can gain a deeper understanding of market sentiment and potentially make more informed trading decisions. Section 5. Bull versus bear. Strategies for different markets. As we mentioned earlier, markets are like the weather, constantly changing. Understanding these different market phases is crucial for choosing the right trading strategy. During a bull market, the overall trend is upwards. Prices are rising, optimism is high, and everyone wants a piece of the action. This is the time to buy the dip, buying during minor price pullbacks and riding the upward wave. In contrast, a bear market is characterized by falling prices and pessimism. It's like a deflationary balloon, slowly losing air. During these times, short selling becomes popular. This involves borrowing an asset, selling it high, and then buying it back later at a lower price, profiting from the difference. However, not all markets are clearly bullish or bearish. Sometimes we experience sideways or range-bound markets. Here, prices fluctuate within a defined range, like a leopard pacing back and forth in its enclosure. This is where traders often employ strategies like buying at the lower end of the range and selling at the upper end, profiting from the oscillations. Remember, there's no one-size-fits-all approach. The key is to identify the prevailing market phase and adapt your strategy accordingly. Section 6. Riding the waves of volatility. Volatility, in simple terms, refers to how much an asset's price fluctuates. High volatility means big price swings, while low volatility indicates a calmer market. Think of it like the difference between driving on a bumpy dirt road and a smooth highway. For some traders, volatility is their best friend. They thrive on the excitement of big price swings, using strategies to profit from the ups and downs. Day traders, for example, often capitalize on volatility, aiming to enter and exit trades within a single trading day. However, high volatility can be a nightmare for others, especially those with a low risk tolerance. For them, calmer markets with less dramatic price movements are more suitable. The key is to understand your risk appetite and choose strategies that align with your comfort level. If you're comfortable with risk and enjoy the thrill of the ride, high volatility markets might be your playground. However, if you prefer a smoother journey, sticking to less volatile assets and markets might be a better approach. Section 7. Economic Data, the Market Mover. Imagine you're at a braai and someone announces that the Springboks just won the Rugby World Cup. What happens? The atmosphere erupts. Everyone's excited and the party kicks into high gear. That's what economic data releases can be like for the financial markets. These announcements, like interest rate decisions, inflation figures, and employment reports, can send shockwaves through the markets, causing prices to jump or plummet. Traders and investors eagerly await these data releases, trying to anticipate how they might impact the markets. For example, a positive jobs report might boost confidence, leading to higher stock prices. Conversely, a surprise interest rate hike could trigger a sell-off, sending prices tumbling. Reacting quickly to these announcements is crucial. Traders often use a combination of fundamental and technical analysis to gauge the impact of the news and adjust their positions accordingly. Some might buy on positive news while others might sell on negative news, aiming to profit from the price movements. Understanding how to interpret and react to economic data is an essential skill for any trader. It's about staying informed, anticipating potential market reactions, and being prepared to act decisively. Section 8. Patience, discipline, and ongoing learning. Trading, like any skill, requires patience, discipline, and a commitment to continuous learning. It's not a get-rich-quick scheme, and there's no magic formula for guaranteed success. Patience is crucial. Don't expect to become a millionaire overnight. It takes time to develop your skills, learn from your mistakes, and build a solid trading strategy. Rushing into trades or chasing quick profits often leads to costly mistakes. Discipline is equally important. Stick to your trading plan, manage your risk carefully, and avoid emotional decisions based on fear or greed. It's easy to get carried away in the heat of the moment, but remember that discipline is what separates successful traders from the rest. Finally, never stop learning. The financial markets are constantly evolving, so staying ahead of the curve is crucial. Read books, attend webinars, follow market analysts, and never be afraid to ask questions. The more you learn, the better equipped you'll be to navigate the complexities of the markets. Section 9. Conclusion: your journey to market mastery. Mastering trading strategies is a journey, not a destination. It's a continuous process of learning, adapting, and refining your skills. There will be ups and downs, wins and losses, but the key is to stay focused, disciplined, and never stop learning. Remember, there's no one-size-fits-all approach. What works for one trader might not work for another. It's about finding your own style, understanding your risk tolerance, and developing a strategy that aligns with your goals. Embrace the challenges, learn from your mistakes, and never be afraid to ask for help. With dedication, perseverance, and a thirst for knowledge, you can navigate the exciting world of trading and potentially achieve your financial goals.